All right, people. Good morning. Good morning. Good morning. It is the Blacksmith back in the forge for another one. Over here, we take guys and forge them to men. But Saturday, Saturday is our financial topics, and we are going to get right into it. Now, I have a great show lined up for you. Number one, you can see the portfolio, right? This is just my Robinhood portfolio, and we're going to talk about what the market's doing, what it has done over the past week. Then we're also going to go over the outlook for the market. It is August. And if you were not on the last show, then maybe you are not aware that August and September are two of the worst months for the stock market, period. Right? So we're going to go over stock drawdown and pullbacks so that when you see it, you're not freaking out. We're going to go over one of the best dividend stocks that I have found. It is the best dividend stock I have found to date. So stay tuned for that. So if you want to plus up your money, well, let me just say this: you earn money while you're awake. You create wealth while you sleep. What does that mean? Well, while you're awake, you're at your 9 to 5 and you're earning money. Some people say make money. I happen to think like Earl Nightingale, the only people who make money work in a mint and they're actually creating money, right? Neither here nor there. But you earn money from what you do at your 9 to 5 job while you're awake. Then you take a portion of that money, should be about 10% at least, and then you invest it. Now, if you're investing it into the stock market, into buying homes, things, assets, right? Things that are going to appreciate, then your money while you're asleep will also work for you. So you're earning money around the clock. Those are the people who are going to be wealthy. Okay. That's what that means. So, and then the second half of the show, we are going to cover options trading. Now, this has been requested over and over and over again, and I'm going to add my spin on it. I'm going to add my flavor on it. I'm going to put definitions behind everything so you are no longer confused. And I might actually do one here. I'm going to actually do one on the show and talk you through how to do it. Once we go through how to do one, I'm going to show you how to actually do it right here live on Robinhood. That sound good? Hey, all right, strap in. Um, Strap in. I'm trying to wait for some more people to get in on the Discord side, but I think it's time to go ahead and start this show. So the first thing we got for you, okay, as you can see, Robinhood offers a lot of different things, right? So they offer a lot of services, right? Robinhood is our MVP stock over here at the Blacksmith podcast. Robinhood. So as you can see on the screen, you're earning another 1% bonus when you transfer your outside brokerage account into Robinhood. Let me get my chair out of the way, out of the video. Bad chair. Okay, so that's one other thing that they offer. Now the market. My portfolio saw a 9% drop this week. I was at 88 grand, and over the past month, it's still seen a 4% growth because we started down here at 75. We hit highs here in July, 90 something. Yeah, I can't get this peak right here, whatever this is. 91, 92, something like that. But over the past week, it has dropped. And I am not freaked out by it because I understand market cycles, right? The market has a cycle for the year. And so if you look right here, see right there, they already knew what I was going to type. Best and worst months for the stock market. Let's go with the Motley Fool. I love, I like their I like their website. If you find Investopedia, that's a good one. Wall Street Journal is a good one. Um, okay, let's get to it. Where is it? Mm, all right. So it says 4 months stand out as being particularly strong. As the end of May 2023, only 4 months have produced an average of greater than 1% annual return for the S&P 500. That would be July, April, December, and January. Now, there's reasons for this. July is the best month of the year, so my portfolio saw a dramatic growth in the past month, 3 months. Well, we were coming off of the 3 months. Now there's some nuance to the 3 months being 80% gain. It was actually higher before that 3 months ago. Well, it's August now, August 2nd, right? Happy birthday to my mom. Yesterday she hit a milestone, 60 years old. Um, and while we might tease her about being old, she grew up with some people who didn't make it to 60. Now, by 60, you have people's parents dying. You have people's health already have failed by 60. You have people buried their own children, their aunts, their uncles, loved ones pass away. Um, they've been hit by cars, they've drowned, like all sorts of things. And I know that's morbid, but I'm saying happy birthday to my mom because to make it to 60 is truly a blessing. Yes, your body has broken down from what it was at 18, but that's going to happen. But it's really a blessing to see 6 decades upon God's green earth. So happy birthday to my mama. I love you, mama. All right, my dad went on to be with the Lord about 4 years ago. So he was 63. His death was untimely, actually. So I got one parent left, and she is alive and kicking. All right. So now, the nuance from this, we're in August. Now, let's just take 2 days ago, July 31st. 3 months from that, we were in August. We were coming off of the tariffs, where a lot of stuff came to a screeching halt and actually plummeted, right? So that 80% rise in 3 months, some of it was getting back to where it was in the beginning. All right. All right. Now, let's move this thing right along. So the market we know is poised to come down. So now we know the best months for the market is July, April, December, and January. Now we know that. Oh, you know what? I'm sorry, folks. You know what? You guys couldn't see it at all. You didn't miss much. The Motley Fool right here. And you know what? I'm streaming it or recording it on this side and I'm talking through it. And I'm telling you what it says, but now I'm sharing my screen and you can see what it says. That's kind of a dee moment. Anyway, so now you see it. July, April, December, and January. Those are the best months for the market. And it tells you why. So December is the Santa Claus rally period, right? And that bleeds over into January as well because you have people in November and December buying everything they can for Christmas. And then what they'll do is that spending bleeds over into January because right after Christmas, what do you have? The after Christmas sales. And things drop 10%, 20%, 25%. And in January, it might drop 50% because they want all that inventory gone. And what are you going to do with it if people don't buy it? So you drop it way down before people just all together stop looking for holiday stuff, right? A lot of it's going to be holiday themed. You're going to have Rudolph and his buddies that you put out on the front lawn and they light up and maybe they move their heads and they take a step and step back like the Jackson 5. I don't know. They out there doing the robot, that dancing machine thing. He don't get me to because I can't dance. Um, But a lot of it's going to be holiday themed, so they want that inventory gone. And it's good to put the science or the economics behind what drives these months, right? April is common sense because the cutoff for the tax deadline is April 15th. But from January, when your W-2s come out, the end of January or early February, right? You can start filing taxes. And most people wait until April to get it done. There's so many people every single year that are just so lazy. They only work a 9 to 5 job. So all they've got to do is take one piece of paper to H&R Block and get them to do their taxes, or somewhere. H&R Blocks is the first thing that came to mind. My wife had it written on her notebook here on a piece of paper, so I use them, and they're well known. So they all they have to do is take it there, and they can't do it for 4 months. So really and truly, all you're doing is delaying the return that you could have, because most people don't have their taxes set up to where they get all of their money throughout the year, so their return is very minimal. Or because the worst thing is you may owe the IRS $50, right? Um, but you would get your money year round, but most people want the check at the end of the year. So you just give the government a tax-free loan on your money. Now, I don't care if that's what you want to do and you like the joy of getting a check, whatever. But if more people had their taxes set up correctly and they didn't get a return at the end of the year, the government would have to shift and move some things and how they do things, um, because they're not getting a tax-free loan from people. But anyway, to continue this, so now, and it talks about July too. As for July being the best month of the year, may have something to do with the index rebalancing undertaken in June, getting outperformers into the S&P 500 while shedding the proverbial dead weight as the potential to provide a lift. Okay, so let's deal with this one right here. The S&P 500. The S&P 500 are the top 500 market cap companies and top performing companies out there, period, right? So what happens is and I'm not talking about private companies, I'm talking about public companies. So if they're still private, but they're outperforming somebody in the S&P 500, hey, that's on them. Anyway, so what they do every year in June, they're saying, is they look at the companies who have not performed well enough to be in the S&P 500, looked at other companies who have. Robinhood is on the wait list to get in, and they shed, let's say 2 companies fall out, and Robinhood's next up. They'll get in there, and then they'll bring another one in and lock that S&P 500 down for another year. They want the top performing companies in there, because most people, you don't know this, they're individual retirement funds or accounts, I'm sorry, individual retirement accounts, IRAs, mostly seen in the form of 401ks, 403bs, TSPs, thrift saving plan. They invested into the S&P 500. So if you say, I don't want my investment to be risky at all, take the risk out, they're going to put it directly into the S&P 500. You're going to get about a 10% return every year on your money, and your money's going to work for you, about 10% of it. All right. All right. So now it says that when the S&P 500 does the end of the month higher, July also takes care of the largest average gain. So that they're talking about July. Now I want to deal with the worst months. Here we go. Now, statistically, the worst performing months. All right. Now they're saying this is from Wall Street now. They're saying September, February, and May. Now, what I went over last month also included August. It was a different article, but there was a reason why, because July was the best gaining month for the market. So if July's the best, it has to teeter off in August, because it has to create that peak. If it doesn't teeter off in August, then that means that August would also be one of the best performing months. So it teeters off in August in preparation for September. So if your portfolio if you're in equity stocks, right? Well, even if you're in, I guess if you're in more dividend stocks, it's still going to happen. There'll still be a drawdown. There'll still be a pullback in the equity of the stock. So, I mean, if you bought it at $10, it still may pull back to $8 or $9. If you're in equity stocks and it's at 100, it may pull back to 85 or $80. So if you see a pullback in your portfolios or a drawdown in some of the stocks, don't freak out. Remember, the market has cycles, right? So September is the worst month pound for pound since 1928, almost 100 years, 97 years for the S&P 500. And the S&P 500 drives a lot of market cap for the stock market. It drives most of it. So if the S&P 500 loses 10% in a year, the market's going to lose 10% in a year, more than likely, right? Because the highest market cap companies, pound for pound, that's going to move the market are in that index fund. February is also a terrible month. February is a terrible month, remember, because December and January are two of the four best performing months of the market. But remember, in order for it to be one of the best, it has to have a peak somewhere. So December comes up and it stays like this for January, but then it peaks. It has to drop off for February because all of that holiday spending stops. So February ends up being a bad month for the stock market because all that spending drops off. And in April, it peaks up again because people are filing their tax returns and they're getting a check. So what do they do with the check? Most people most people are in the poor class because they have a middle class mindset, earning a poor man's wages. And so the middle class mindset, as soon as they get a check, they go and buy things with it. And so they remain poor. They buy things, and so the debt they already have, they're not paying off, and they make more debt, and so now they have to work harder, but it's just to pay the debt, so they never move up. If the poor man had the rich or wealthy class mindset, then he would be investing 10, 20% of what he earned, stop buying things, and he would then move himself up net worth wise, at least with assets and things, and he can move into the middle class with given some time, right? So anyway, and then May is the other worst performing month, and that is due to the fact that April, all of the refund checks come in because most people, your W-2 drops in January. I just said this. It drops in January, but most people are going to wait until the last minute. April 15th is coming up. That's the college application deadline, and that is the tax cutoff deadline. There may be some historical reason why the two of those dates are married up, right? Because you have to pay tuition, you got to get money for the application, and they have to start doing enrollments, right? And they need a couple months to say yes or no, getting acceptance letters and stuff like that, getting their dorms packed, figuring out what budget they're going to have before the fall semester starts. Anyway, so we've talked about that. So now you know, if you see a pullback in your portfolio, don't panic. The market is going to draw down for August, only if not for anything but the fact that July is a power month for the market. So it's going to draw down in August, but it's going to perform even worse in September. But if you have set some of your income aside and placed it in your portfolio, you can be ready to pounce in September where things have bottomed out. Because if September is the worst performing month of the stock market for the last 97 years, then that's where it's going to bottom out. So you guys in Discord, if you're paying attention, you don't have to ask, do you know where this market's going to bottom out? September is the worst performing month by far. Look at that, a whole percent worse than in February and May, which are the other bad months, right? A whole percent. So September is the month where things are going to bottom out. So it might be halfway through September where it's going to bottom out. And if you start seeing it creep, follow the S&P 500. If you start seeing it creep back up towards the end of September, then you know it's on its climb. So any stock you've had your eyes on, you might have a good place to buy right there. 10 to 30% drop in Nvidia and Microsoft, Apple, Amazon. I'm only naming tech, really. Let me throw one non-tech in there. Costco. AMD just started firing it up the last week or two. And they're number 2 in the chip space. TSM, Taiwan Semiconductor. If you've had your eyes on any of these stocks, Robinhood running it up, I'll definitely throw my MVP in there. SoundHound AI is still cheap, but they're going to run it up. They're shaking hands, doing business dealing. So again, if you see your portfolio pull back, you'll know why. I'm going to save my MVP dividend maker to the end, as I want people to watch till the end if you couldn't tell. But I'm going to save that one. Now, today, we are going to do the options class. It's been long awaited. It's been requested over and over and over. And I have some of the stuff pulled up right here. Investopedia is a incredible site. If I haven't championed, I'm going to start doing that too. So I championed Robinhood as my MVP stock. It's also my MVP platform. And there's a lot of reasons why. We're going to go over the call when they do that, their earnings calls. So everybody's doing their earnings calls right now for the next couple of weeks. Expect us to cover at least maybe one earnings call if I don't cover something else, depending on how long the earnings call is. And we have to do that, right? We have to keep you locked in to what the companies you're investing in are doing. And if there's specific, especially for the Discord members, this is going on YouTube. So if anybody on YouTube as well want me to cover a certain stock's earnings call, put it in the comments on YouTube, or go ahead and throw it in the chat in the investing channel on Discord, and I'll cover it. So Investopedia, their CEO actually did in an interview with Earn Your Leisure. So I got to see him and where he's going and what background he has. Investopedia is the encyclopedia for anything money related. If you've never been taught to have a great relationship with money or good relationship with money, start searching up terms on Investopedia and it will show you. And I signed, sealed, delivered Investopedia. I give it the Omni. Okay. So now we're going to cover this video. And this one is from Earn Your Leisure. They did this 3 years ago. So I will tell you a little background on Earn Your Leisure really quickly. Earn Your Leisure has been around since 2019. Now, I didn't find them until 2021. They've been around for 2 years already. These guys, they both have financial backgrounds. Troy Millings, as captured on the left, he is the bald man right here. He was a physical education teacher, but always was in the stock market investing. And Rashad Bilal, who is not actually naturally bald, he can grow a full head of hair. He did it last year for a couple months. He just shaves his head. He was actually doing what I'm trying to get my credentials to do. He was a financial investor for like 10, 15 years. So these guys are incredible with their knowledge. So we're going to play this video, and anybody in the chat, if you want me to stop the video and you have a question, please go ahead and ask. I'm going to make it full screen So I'm not looking at Discord right now. Um, well, then how would I know if you ask, right? Yeah, let's go back down to half screen. Let's do that.
So here's the question. I need everybody to honestly answer this
Can y'all
question
hear
right
this?
now. So, do you think Apple's price, the stock price, which is currently trading at $175, can trade at $200 by January 19th, 2024?
Let me back this up.
So here's the question. I need everybody to honestly answer this question right now. So, do you think Apple's price, the stock price, which is currently trading at $175.86, can trade at $200 by January 19th, 2024? Put your answers in chat right now.
Let's stop it right here. Let me show you what he's doing. I'll take Robinhood. I'm going to walk you through this. I do understand options enough to teach, but I know there are stronger teachers in this. I'm a journeyman. I'm not a master of this craft. I don't like talking on stuff that I'm really not a master of, especially when it's this important. Because if you do an option play wrong, if you do an option wrong, you start wrong, you buy it at the wrong level, you could lose money on it and there could be no getting it back. So you have to be very, very careful with options. Whereas if you bought a stock too high, like let's say you bought stock shares in July. Now, if you're dollar cost averaging $10 a week, $20 a week, every week, doesn't matter because you're going to buy at the highs and the lows. So you're going to average out during the year. So that question was asked by somebody in the chat, and that was a very insightful question, and I didn't cover it. So that was a great one. Now, but if you buy an option wrong, you could be cooked right away. All right, so Robinhood is trading at $99 currently. What he's asking is, let's pick a number. What did they pick? Like 20, 30 bucks? Do you think in the next 2 years, Robinhood, with this trajectory, the last month, it have lost 6%, but in the past 3 months, it gained 4.5%. Past 3 months, it gained 112, so it more than doubled. So from January to now, it's gained 150%. And in the past year to year, it's gone up 400%. So if it stays on that trajectory, even in the past 5 years, it's more than double, right? So right now, do you think Robinhood could hit in the next 2 years $120? He said put yes in chat. So if you think it can, then what he's going to do is, okay, so the share price is here. Let's just stop right there and let's play the rest.
A lot of yeses.
I see for sure. Hell yeah. Right. So based on what you know about Apple and based on what you know about the economy, you said yes. Like most people have said yes, of course, right? Is this even a question, right? So basically what you've done is you've predicted the potential price of a stock in the future. And that, in a simple sense, is what an option is, right? You just did it for the growth. And we're going to talk about what it is when it grows and when it depreciates, when it falls. There's two types. So everybody got the question right. And so let's keep moving. Right? So, like I said, essentially, the future price prediction of a given asset is what you just did, right? Here's the example. The asset was Apple. That was the stock you chose. I gave you the price, what it is now. That's as of today. It might have went down a few cents after hours. The future price prediction was $200, and that's the strike price, and we'll show you how we came up with that.
Warning. Don't believe the AI trading hype until you watch this entire
folks,
video.
I don't have the YouTube
and the future
Red
date,
or whatever.
Right? So January 19th, 2024, that's a little over 2 years away. That's the expiration date. And so when I say expiration date, is because you're giving yourself a specific time to have this number be hit. Now, granted, it doesn't have to even hit 200, and we'll talk about why. Because there's money that can be made either way, if it makes it to it or if it doesn't. All right, so I need everybody just to understand that piece.
All right, so he said the example is Apple at 175. Future prediction, you think it can hit 200. and you're looking at an expiration date. Let's say that's 2 years in the future, because the longest you can go is 2 years, right? So strike price. So we think Robinhood can hit $120. So let's say we think Robinhood can hit $120, and we're going to buy, not sell, and it's going to be a call. Because if you think the price can go up, it's going to go up, and it's at 99. You can see it down here, right here at the bottom. It stays in the middle. So you're going to buy, and you think it's going to go up. That's a call. If you think it's going to go lower in 2 years, that's a put, right? You still buy, but it's a put. And now your expiration date. Take it all the way out, December 17th, 2027. Wait, go back. You have to pick the end date first. So now I think the strike price can hit 120. So now I go to buy this this call. It's going to cost, well, he's going to go over the cost a little later on, but that's what he essentially did. So I'm walking you through what he did. Strike price is over here in the left column. He said, do you think it can hit that price? So that's about $20 up from what it is in 2 years. That's all he's saying. You're betting or predicting that the stock price is going to go up. Okay, I think that's enough.
All right, go ahead.
Yeah, so what are option contracts? Option contracts offers the buyer the opportunity to buy or sell.
Oh, him? I saw this episode. Sorry, let me stop.
Depending on the type of contract that they hold. So the chosen asset is at a price set out in the contract at expiration date. So this is key. Options differ from shares. So a lot of people a lot of times get confused and saying, am I making a call or a put, or am I buying or selling shares? So when you're holding options, every option that you hold is worth 100 shares. So you can be a buyer of options, and you can also be a seller of options if you have more than 100 shares. So for every buyer, there is a seller. So each contract is worth 100 shares, which is why you always see contracts expressed. Sometimes you see $25.26. That's really $2,526 per that option contract. So always remember that option contracts are broken up and always worth, every option contract is worth 100 shares.
All right. He said it over and over and over so you can understand, but let me show it to you now. So if I wanted this option right here, if I think it can hit $120 within the next 2 years, my strike price would be $120. Now, forget all this stuff in the middle right now. Look all the way to the right. It's showing you that to buy this, it's $33.25. What he is saying is that because you're buying the ownership to 100 shares, and it shows you right here, you have to move this decimal to the right 2 times. So it's not going to be $33.25. This will cost you $3,325 because it's 100 shares. One share would cost you that much, but you can't buy one share because you're doing an option. If you want to buy a share, you have to spend $99.20. So it's actually giving you, you're buying the options contract at a third of what you'd buy 100 shares for. Is basically what it's doing. If you want to buy shares, it's going to cost you 3 times as much for 100. But if you want to buy the right to 100 to predict 100 shares to hit, well, one share to hit $30 more in 2 years, you buy it at a third of the cost. All right. So that's just so you can see it. Hopefully this makes sense. Chat, let me know. If not, I can break down something else.
And you have
But
the right to purchase those 100 shares at that expiration date, as long as the contract is potentially fulfilled. And so,
okay, what he's saying is, At this expiration date, December 17th, 2027, if you have not already sold the contract to somebody and gotten the money from selling it, when it expires, which is 867 days from now, you can actually buy the 100 shares yourself if you want to. So most people, I'm going to tell you right now, they're going to sell this contract before it ever expires because they can earn a lot of money off of the contract, off of options. But and I only do options that are going to be winners. I pick solid companies and I do 2-year leaps. A leap is anything, oh, it's a long term option, right? I only buy contracts I know I'm going to earn money off of. I don't take risks with options. I just don't. I always buy 2 years out. I don't do a week. I don't do 2 weeks. I don't do short contracts. So anyway, he's saying that if this contract expires, you have the right to buy those 100 shares outright if you want to, or you could have sold it beforehand. That's what he said.
In order for that contract to be fulfilled, the stock actually has to go above the strike price, which we'll talk about.
Yeah, and I want people to be very clear about that. And I put it in bold letters for a reason. They're contracts, they're not shares. And so when people buy a share of a company, or we like to say when we're teaching kids, a slice of a company, right? You're going to pay the equities price at that time. So today, Apple was 175. 2 days ago, it was 171. If you wanted a share, that's how much you would pay. Options are completely different. They're not based on the share, although that does take into account how the bid and the ask is perceived. And we'll talk about how that works too.
Yep.
I'm going to throw them a like on this video.
Yep. So you have right here a stock option contract is the option to buy or sell 100 shares. So one contract equals 100 shares. So you can buy multiple contracts. You could buy 2 contracts. That would be 200 shares. 3 contracts, 400.
Imagine being able to build anything just by thinking about it. Meet Base 44.
Imagine not playing a commercial when I'm trying to go over something.
And then,
real quick, let me say this. This may sound confusing. He's saying one contract equals 100 shares. You're not buying 100 shares with one contract necessarily. If you bought, again, let's put pen to paper, or let's put the math involved. With one share, you'd spend $99.20. So if you wanted 100 shares, you're gonna spend straight up shares. You're gonna spend $9,920. I don't know how your bank account is set up, Kevin Hart, but the way mine is set up, I don't have that just sitting around, right? So I couldn't actually buy 100 shares right now. And options, however, if I wanted to buy the right to 100 shares and predict that the stock price is going to go up, it will only cost me in 2 years. In 2 years, that's important. And you can play with the dates. The prices change based off of how close in or how far out the expiration date is. They'll get more expensive as the expiration date goes further out because the stock has more of the share price has more of a chance to hit that price, if that makes sense. So when I did it was on 7 days at first, it was like 80 cents or something like that for $120. I'll just show you. So right here, if I change it all the way to 6-day option and I go to 120, see how cheap it is? It's 18 cents. You know why? It's so cheap because 100 shares in 6 days does not really have the chance to hit this. Now, if this was the beginning of July, yes, you would have more of a chance to hit this because remember, July is the power month for the stock market, right? But it's August. It doesn't really have, and see, that's important for you as the investor to know. Everything matters. You need to know the best and the worst months for the stock market. You need to know all this stuff, the trajectory of the company, if they're doing their earnings calls, you need to know all that stuff. the technical analysis behind the company, you need that plus this. But what I'm giving you is just basic, right? The shorter the expiration date, the closer it is, the cheaper the call is going to cost because it has less of a chance to hit that price. But the further out it goes, the less of a chance it has to hit that price. So you're paying a third of what you would pay to buy the right to 100 shares versus buying 100 shares. It'll all make sense in a minute. I just want to make sure you understand that.
And you take a look, 3 contracts, 300, and 4 contracts, 400. So this is imperative, important for us to kind of understand. A lot of times when people are taking a look at option contracts, a lot of times they get confused. They're saying, okay, why am I purchasing this one contract? How is it worth 100 shares? So on the sell side, where do option contracts actually come from? So option contracts actually come from sellers. So you have people who may own 1,000 shares of Apple and they decide to actually sell you the actual options. Those options actually cost a what? A premium, a select premium. So it's imperative to understand that option contracts are always worth 100 shares, and this is how they're actually created by a seller. A seller sells you that option. You pay a premium, so you pay a price. The seller collects that premium.
Perfect. All right, so there's two types of options, and this is for beginners. Obviously, there's more advanced, and we can talk about that maybe a little bit later because I'm sure some people are involved in trading.
Do not get caught up in the seller of it just yet. Don't worry about the whole premium thing. We'll go over that. Just focus on what we're talking about right now with how the breakdown of what a call or put is. Okay.
Options. But it comes down to two for the beginner stage, and that's calls and puts. I'm going to talk about calls really quickly, right? So calls, that pretty much is if you think the stock price move up, you're going to make a call. So a call options are speculating on the price increase of an asset. They are the financial contracts that give you, the buyer, the right, but not the obligation. So you don't have to, but you can buy an asset at a specific price within a specific time, which would be that expiration date. So a call buyer profits when the underlying asset increases in price. So Apple, this is our example. We're going to use Apple because it's the greatest company in the world, right?
It was at this point 3 years ago. Apple was the first $1 trillion market cap company. Nvidia is probably about to be the next one. I think there have been another one since then, but they were the first, right? That aside, that's why he said that, because this was 3 years ago, and Apple has kind of teetered off. But anyway, what he was talking about, you have the right to purchase those shares at that price if it goes above the strike price. So let's say 2 years from now, Hood hits 121. It'll fulfill the contract and give you the right to purchase those 100 shares at that strike price. I don't know how your bank account is set up, Kevin Hart, but I don't have that kind of money. And so now let's say though it went to $150 in 2 years. So here's the other side of it. If it only went to 121, you're not getting the most bang for your buck. It'll fulfill and allow you to buy 100 shares at 121, but you're only getting $1 of equity on the share price, right? But let's say it ran up to $150 in 2 years, which is with Robinhood is totally possible, right? Because of what they're offering their shareholders. But here's the thing about that, right? Let's say it did run to 150. Now you're getting a $30 discount on what somebody else would have to pay for. Another way to look at this is you're locking in your buying position 2 years from now, right? So if it goes to 150, you've locked in your right to buy it at 120. That's another way of looking at it. So now, even though 2 years have gone by and it's 150, you have the right to purchase 100 at 120. So in 2 years, people are like 150, oh, it's so high, man. If it dropped to like 120, I'd totally be in. You are locked in because you made the prediction right now. So in 2 years, 120 will be a great price to get in for that stock. That's another reason why people buy options, okay?
Right? Apple, if it currently is at $175 per share today, if I'm looking at the future price of it, and I believe that it's going to go up, and majority of you said that, yeah, by January 2024, it can make it to $200, then I'm making a call on that because I'm saying that the price of Apple will appreciate in that given time. Now, as it appreciates from 175, if I bought that call today, I'm going to make money all the way up until it hits 200. I'll make even more money if it passes 200. And so this is key to know the difference between the two, right? So if I'm saying that the price is going to go up and I believe in that, and again, we're investing in solid companies, right, that have appreciation and have growth and strong fundamentals, then I would make a call. Now, we got to say this.
Before he says that, he's going to say investing has a considerable risk, I'm sure. I backed it up 5 seconds. Understand what he just said, right? These guys are the experts. I forgot about this Lawrence dude. He actually has his own channel, and I watched a couple of his videos. He's very good. He breaks it down to the molecule like Investopedia does. But he's going to say investing has considerable risk. I'm quite sure of that. I haven't seen this for 3 years because I only watched it the one time. But they always say this. This is a slogan in investing. Anyway, he's saying that if it goes, you know what? I just totally forgot what I was gonna piggyback on that because of all that preliminary stuff. You know what? Forget it. Oh, I know what it was. He said he only invests in solid companies. Didn't I just tell y'all that? Do not just pick any company. I don't care if you heard it on the news. I don't care if you heard it from Nene and them who've never invested a dollar into anything in their life. Do not take it. This is very important. I don't care whose feelings it hurts. I don't care who says what, because it should hurt your feelings if somebody gave you advice about what to invest in, you did it, and it lost you money and they didn't cover the loss. Would they cover a $2,000 loss if you had it off of their advice? No? Well, then you shouldn't be taking advice from them. And I mean, these are people, I'm saying, and what I'm getting at is don't take advice from people who are not proven. If they're just telling you, I know Nike's a great company. I showed you a couple weeks ago where Nike was down for the year, down for like 2 years. Nike had been down, but they're telling you to invest in it because the Jordan shoes. They have no idea what they're talking about, right? And that's how you always have to look at it, right? Pick solid companies. Don't just pick the call or the put because it's cheap, because you have no, if you have no foundation on what the company offers, where they're at in the space, are they the number one in the space, number two in the space, number three? If you don't know any of that stuff, you probably shouldn't do it. Now, NVIDIA is number one in the chip space. AMD is number two. TSM is the top semiconductor maker. We already know Amazon is in delivering and products, and they're an AI using company. They're huge, right? We know what Amazon offers, and who's beating them on their delivery dates and the amount of factories they have and the ability to get products to the customer the fastest. Who's beating them? Number one in the space. See what I mean? Apple, number one in their space when it comes to smartphones. Well, they're a tech company, so they're not the number one tech company, but their market cap makes them one of the strongest companies out there. Their trajectory is kind of iffy right now, but it wasn't 3 years ago, so he's using them. I said a lot. Let me play the video.
and strong fundamentals, then I would make a call. Now, we got to say this, investing has considerable risk.
You get hurt in a car accident and they give you a check that
I'm
wouldn't cover
sorry,
my
just
shoe
came
shine.
back
That's
on and here come a
disrespect. With
commercial.
Case
Let me let
Connect,
it
you
play.
don't just
And we always stress to people, please, if you don't know how to trade stocks, you probably shouldn't start with options, right? You should probably have a portfolio that has some stocks in it, that some long-term companies that you believe in. Obviously, Microsoft and Apple, we talk about a lot, NVIDIA, AMD, all these companies that are strong, you should have stock in them. And then if you want to invest in options, I think it's a great idea as well. So those are calls. If you think the price is going to go up, you're going to make a call on that option.
Yep. So then we have on the opposite side, puts. So put options. So put options actually allow you to make money off of assets price going down. So put options can be very lucrative. A lot of people always ask, what can you use put options for? So there's been a myth that's been going around for years on top of years where we haven't been in this space, where we've been tricked out of when we think, hey, that the stock market, you can only make money off the stock market going up. But you can actually make money off of Apple stock price coming.
All right. Now, when he says he's probably talking about black people. Listen, when we say we over here, money's green. I told you, you're talking about political side. I'm not blue. I'm not red. Let's be purple because money is green. And there's pros and cons to each side you look at, right? He's talking about black people. I'm gonna tell you who I mean when I say we. Us who have not been taught to have a good relationship with money. Us from the poor class who have not been taught anything about investing. Us that are naive and don't know about the stock market or why you should invest, and which is the reason why this show exists. That's who I mean when we say we.
Down, Nvidia, Tesla, whatever stock, Intel here, you can make money off that stock price actually declining. The increase, so what happens is you pay a specific premium, and if the stock price goes and falls, for example, Intel here, Intel's at $50.62. If Intel then falls $5, you can profit off of that. So instead of you just holding shares, and when you're holding shares, you may lose value of your shares when they decline, you can actually profit and make money. So I tell people that this is a great strategy to use, especially on red days and times of market turmoil. So for example, when the coronavirus first hit, people actually profited off that market downfall. When we saw the markets decline 36%, people just did sit in their positions and hold shares and just see their value, their shares decrease. They also use put options to actually hedge against their portfolio. So the reason why I really like put options is honestly because you can actually make money to the downside with a stock going down, and then you can go ahead and purchase. So one of the things that I really like to say about put options is I utilize put options on Square most recently. We've all seen that Square is what came down from.
All right, before he gets into that, I'm gonna back that up 10 seconds. Listen, this is what he's saying. You and Robinhood's a terrible one to use for this, but Intel is a great one to use for this. So let's look at the 1 year chart for Intel. They're down 12% in the last year, right? So they would be a good one. So let's trade Intel options. Let's leave it on buy. Let's throw put, and let's change what he was saying during COVID. Let's say Intel was at $50. Intel might have fallen to $20. So it's at $19. So if I bet 27, that's betting it's going to go up, which is kind of weird. All right, so it's at $19. Let's say in 2 years, I bet that it's going to fall to $15. And look, each one is worth $2.40. That's 100 shares, right? So that means that it's going to be $240 total for 100 shares. Now, what he's getting at, let's say the tariffs get announced again and the tariffs go into full effect. I would never pick Intel because they're not a solid company. He's talking about investing in solid companies. So let's go back to Robinhood. So Robinhood's trading at $99. I can talk before I get there. Robinhood's trading at $99. Now, let's say I wanted to buy a put on Robinhood because the tariffs came out. And we saw what the tariff shook, how the tariff shook the market before. So they started the year at 34 bucks. They got up to 65 in February, and then tariffs got announced. And here in March, 36, and here in April, 34.17. All right. So from 65 or 66 bucks, 65 back here, all the way to almost half, right? So 40% drop at least, right? Let's say the tariffs get announced and it goes into full effect again. Now, what he just said is hedging, right? What is hedging? It's playing both sides to your advantage, basically, right? So I own 305 shares. You can see that right here. Follow my mouse and my cursor, right? 305 shares. Now, I bought them at an average of $18.98. You'll never see that price on Robinhood again. Unless they get to 100 and they do a 10-for-1 split, which will drop it right now to $9, which would be a fantastic idea. I go all in. I sell something else, I'm all in. I'd have 1,000 shares. I'm not playing. It sounds crazy, but I might even flirt with the idea of selling my Nvidia and buying it if it went that low again. I'm not even playing. So anyway, what he's saying is when the downside happened during COVID more recently, you can relate to the tariffs, right? So that's what I'm going to use. This is a solid company. So you not only own shares, but you see it's going to pull back because of some big event. Don't just sit there and let your equity fall. So my equity would be this right here, the total return, the 24,000, that's 422%. That's the equity I have in the company, right? That's the equity I've earned off of that price. If you took this, multiplied it by this, you would have that. But if you took what I actually spent on the stock, subtract that out, it would end up on this. So I've only invested about $6,000, 5,800 into Robinhood to earn this 24,000 is what it's saying. Don't just sit there and watch your equity come down. Throw a put on an option on the stock and make a bet that it's going to go down. So throw a put on it. So now on the option, you're earning money the more it comes down. And then when it bottoms out, or you think it bottoms out and your equity starts going back up on your share side, sell the put and earn the money off of the stock dropping down as well. Now that's a more advanced thing, but he just mentioned something advanced. So I had to explain that because we're starting with the basics, right? You're not there yet. Remember, crawl, walk, run.
Go ahead and purchase. So one of the things that I really like to say about put options is I utilize put options on Square most recently. We've all seen that Square is what came down from 240 and 250, and now it's sitting at about 167 at today's close. So using put options, I was able to profit of trading this stock to the downside. But yes, I like Square long term. So guess what? Now I profited off of making money off that stock going down. And now I had the ability to be able to buy shares at a lower price.
Hello, I'm Adrian Hernandez with MyHomeSold.com, and we want to buy your house cash. We'll give you a cash.
Well, you can't have it.
And then I also profited from that. So now I actually have money and equity to be able to pour in on quality companies that I'm now been able to buy cheaper. So,
and then what he can actually use that money to do if he made money on the downside, he said it was sitting at 250. Let's say he bought it at 200. It went up to 250. He had 50 bucks on each share, and he didn't sell it because he likes it long term. He's going to keep it for 10 years. He thinks it'll go back up to that amount, even though it dropped down to 167. As it's dropping down, he has a put on it. So he's making money. And don't forget, he could have had 10 contracts on it. He could have bought 10 if he really, really believed that it was going to fall down because of COVID that much. Let's say it's a job where people really had to be at work to earn money, like a car company or something. They've got to get there and put the assembly line together. Well, I guess that would be the 50s. They have robotics now. But just think of a company that people will have to be at work to make money. The world really got shaken up by COVID, right? So you really know this company is about to fall off the map. You put 10 contracts instead of just one. You get so much more money, right? 10 times what you would have made. And then what you can do is use that money to buy the shares at 167. That's 40 or $33 lower than what you bought the shares for, because your average is 200. So now you use the money you made off puts to average down. Get your average cost for your average share down, so that when it goes back up again, you start to make money off the equity sooner, if that makes sense.
Put options lose value when the stock goes up. So that's key. So unlike call options that when the stock goes up, you're making money, put options when the stock goes
Calls lose money when the stock goes down.
Money on put options.
All right, so I want to tell real quick because I want people to really catch this, right? And so I want you to notice something here. When I made my call option, look how far out I went, right? 2024, which is 2 years away. When I did a put option, right? If you look here in the example, we only went to March 2022. Lauren, tell them why the difference in time frame when we do puts and calls.
Yeah, so like a lot of times if we're taking a look at, how far the market has dropped and went down, we've seen a couple pullbacks here. We've seen pullbacks back here in 2020 where we saw a 36% decline. We saw a bear market that came in 2018. We saw a short mini fall in 2013 and 2015. We saw the financial crisis in 2008. We also saw a downturn in the dot-com bubble. So these downturns have actually been very small. So the timing, when we take a look at the market, of over this 100-year existence of the stock market, 94 years out of the 100, the stock market has actually been going up. So when we take a look, the stock market is going up more than it's going down. So you don't want to be caught in puts on certain companies for long periods of time because you can lose a lot of money.
Perfect.
That is perfect. Let me tell you what he meant. He just threw out like 5 or 6 or multiple different crises in America, right? He talked about, I can add one, the tariffs, COVID, he mentioned something in 13, I don't remember what it was. Something in 18, don't remember what it was. But there's a housing market crisis in 07, 08, where a lot of people lost their homes. Then he mentioned the dot-com. Like in 94, whatever, the dot-com boom that was going on, but there was a downturn. These crises don't last that long because human beings are adaptable, right? So we're going to adapt and figure out a way around it. Didn't we do that with COVID? Yes, the COVID thing happened for like 2 years, but remember, the market was already going back up before that 2 years was out because companies figured out they had to get on Zoom. They had to get on Zoom was a company that boomed during the COVID crisis. And then it came down, right? They had to figure out Zoom and other apps. I can't remember another app like Zoom, but they had to figure out apps like that or Google Meet and stuff like that to where they could have their company meetings still, see each other, show the room and their charts and stuff. They had to figure out how to work from home. So they had different apps for telephone calls, video calls, all kinds of things. You can't have your market failing that long. So a put, you would never want to do it for 2 years because the tariff crisis lasted like 3 months. But in those 3 months, it was already going back up because I think it only really downturned for like a month and a half. And then it started to creep back up, right? So you have to understand a put should be short term because if you're putting puts, first of all, you don't make options on terrible companies. You just don't do it. You make options calls, period. Whether it's a call or put, you're betting it's going up or down on solid companies. So if it's not a solid company, you don't throw an option on it. But if you know it's going to downturn because of a crisis that's going on, you throw a short-term put on there for a month or 3 or something like that, and you start collecting money from the downfall of the market. But when you start seeing it creep back up, you sell it. That's what he's saying. Don't be caught in a put for 2 years, thinking Microsoft is going to go down over the course of 2 years. That is not likely at all. Microsoft is a slam dunk, bar none, Fantastic Seven tech company that is not going to lose. And even in the weaker companies, right, that's not solid, remember, if they're public, people have shares of the companies, they have investors, and those investors are paying those CEOs that see the chief executive officer, the chief financial officer, all these money people in leadership, the president of mergers and acquisitions, all of these people within a company to make a profit out of that company. So I wouldn't bet any company out for 2 whole years. That makes no sense. All these people are trying to figure out a way to make that people's money, their investment in their company, grow. Do not count people out for 2 years. I would not do that. Most people I know that invest in options don't even mess with puts because they're supposed to find a way to go to the upside, and you're betting they're going to go down. That's already a risky investment. That's why he said trading has how do you say it? Considerable risk. And remember, I'm not licensed. I just have a professional opinion. All right.
All right, so expiration dates, right? And so again, when we gave the example, we said January 19th, 2024. For the Intel example, we said March 18th, 2022. And I gave those dates because those are significant dates. They're called quadruple witching. And we said that happens every quarter. So the third month of every quarter, the third Friday, quadruple witching will happen, which means that, and we said this on...
Write that down. Quadruple witching happens every quarter. The third month on the third Friday. Let me let you hear it again. Write that down. Even if you don't know what witching is, if you don't know what quadruple witching is, I gave you a website, Investopedia, to look this up. Just write it down, and we can look up all your terms later. You can put, if you're on Discord, you can put it in the chat. If you're on YouTube, you can put it in the comments, and we'll go over them together.
At March 18th, 2022. And I gave those dates because those are significant dates. They're called quadruple witching. And we said that happens every quarter. So the third month of every quarter, the third Friday, quadruple witching will happen, which means that, and we said this on Market Mondays plenty of times, that contracts will expire. And so when we talk about those dates, those are expiration dates for contracts in March and obviously in December. So an expiration date is the final date on which a contract is valid. So after that time, the contract has expired. Option owners can choose a couple of things. You can exercise the contract, which means that you're going to buy 100 shares, right? So let's say you have 5 contracts. You have the right, not the obligation, to buy 500 shares. And, or you can...
Monday CRM has the best AI features in the game.
Especially in sales.
Hands down.
So for me, email composition.
Sell.
Let me back this up.
The contract has expired. Option owners can choose a couple of things. You can exercise the contract, which means that you're going to buy 100 shares, right? So let's say you have 5 contracts. You have the right, not the obligation, to buy 500 shares. And, or you can sell the option contract. If you haven't made any, if you've made profit, you can take profit there, or you can choose to buy more. So you have 3 things you can do at the expiration date. Here's what we tell people. You don't want to wait to the expiration date, right? You're not waiting to that date to actually make a move. Because again, when the expiration dates come, a lot of people are selling off and taking profits. You want to make sure that you can make the most as possible. So just keep that in mind. Now, expiration dates can range in length of time from days to weeks to months to years. And so we showed you the example, and Rashad and myself, we talk about this all the time. We like to go out in leaps, right? So we like to have as much time as possible for our positions to have their volatility, to have their ups and their downs, for news cycles. And obviously right now we're seeing with Omicron, right now there's pullbacks, right? But we're in positions that are for 2 to 3 years out. It gives us time for it to correct and also appreciate over time. So the longer, this is important, the longer the expiration is also useful. It also retains time value. Even if the stock trades below the stock price, So it's fine if you don't get to your strike price, as long as it's trending towards your stock price, you'll be fine. So these are just two examples of expiration dates. Like next week, December 30th, 2021, could be a weekly, right? So if somebody got into an options position today, that might be an expiration date that they're choosing if they're doing a weekly. Obviously, January 19th, 2024 is years away. So we're talking about a little over 2 years away from now. Again, giving yourself the optimum time, and we're going to talk about Delta and all that, why that's valuable in theta.
Yeah, and I just wanted to add one thing here.
Yeah, go ahead.
Especially when you're just getting into options, guys. I always tell people to buy time. If you're someone new getting into options, first I always tell people, guys, stocks first. Investing in ETFs, investing first is key. I did not trade options until 2 years after me learning about the stock market and studying.
And I'm like him. When I got into this, I started trading like April 27th of 2020. Why I remember the date, not important. But I just do. I don't even know. Anyway, so I didn't start trading options until like 2023 because I had to buy stock first. Crawl, walk, run. You have to buy a share, which is a piece of the company's picture that they cannot make a complete picture without your parts. So you are buying a piece of the company. If you had a 100-piece puzzle and if the company was a 100-piece puzzle and you had the left eye piece, they still can't make the Mona Lisa or a picture of the face without your piece of the puzzle. You own 100th of that company. So you are a shareholder or part investor. You're part owner of Microsoft, Apple, Nvidia. That's what shares are. And it takes time for you to fully comprehend that, right? It takes time for you to fully comprehend that that piece on the left eyeball of the company has now gone up. You bought it. They gave it to you for $10. And over 10 years, now it's worth $1,000 if you were to sell it. But as long as you hold it, it's still gaining value. It takes time to comprehend that. Or let's say after a year, this is worth $20 now. So now you look at the right eye and you say, ooh, I understand how this works. Let me get the right eye as well. Okay, give us $20. Now you have the right eye. Now you have 1/50th of the company. Now you own even more of the company. It takes time to understand that. That's why you don't jump. If you just got an investing, you shouldn't jump right into options right away unless you're securing your knowledge of buying shares first.
So I really want to drive this point home because it's important to understand. I find it that a lot of people are hopping into trading on their second day in the markets, second week in the markets.
Sorry, I'm going to stop it right there with what he said. We're going to probably get halfway through this. I'll probably go another couple minutes. And then the next week, we'll do the second half of this. If you didn't catch the first half of the video, then you need to watch this week and next week as well. I thought I was going to get all the way through it, but I'm already at 1 hour and 13 minutes worth of a video. And you know people got the 30-second mindset nowadays in the world. So I don't want to go too long on the video. But I want to talk about what he just said right there. So July 3rd this year, I had my first speaking event. It was at Temecula or Promenade Mall in Temecula. We had a stage set up. There was lots of performance, singing, dancing, spoken word, and 2 guest speakers. And King Titus was the showcaser. So he was the closer. He was the guy at the end because it was really his event, and his mom was actually one of the guest speakers. I was the second one, right? And so I went inside the mall to use the restroom. We'll just end this video right here. We'll let him finish what he's saying, and we'll end it after his topic. I went into the mall, and there were these guys working at the shoe shine booth. They will shine and clean up your sneakers if you want them to, and then they offer you to buy their product, right? And so I had seen these guys a couple months before. One of them's actually in my Discord. I think both of them now. Both of them are in the Discord. And I talked to them extensively about trading and investing. And one guy, he trades gold. He trades, I think he tries to do like Forex, but he definitely trades gold. Um, and he said something, not me. He said he's in his 30s. He said something very profound to the other guy who's only 17 years old, who told us that he was going to the casinos and gambling and stuff. And then he said his dad is 39. His dad owns the shoe shop booth. He's the franchisee, right? He's franchising that booth in the mall, and he's 39. And I said, your dad's my age. He said, yeah, he gambles a lot. He's always in the casinos. See, right there? That's proof of a couple different things. Watch what I'm about to show you. His dad is my age. His dad is smart enough to know to franchise things, which is an investment, have employees, and grow your business that way. His dad also trades in the stock market. He invests, right? But he's also gambling. And you know what the son has done? Now, maybe he doesn't have enough money to franchise something, but he's not looking to. Maybe he's not 18, so he can't have his own stock portfolio yet. But you know what the son did? The son went after the sexy thing, the fast money. The fast money. His dad owns stuff because he's he's a franchisor of businesses. He's a business owner. He invests in the stock market and he can see that his dad's money appreciated, but he went after the fast money. And so the other guy who's in his 30s said to him, you know, your problem, you don't need to invest right now because your problem is you're going to come into investing with the gambler's mentality and you're going to lose everything that you own. You're going to lose your house investment right now at 17 years old. And I was like, oh my God. And that's what he's talking about. 2 days in the market, people are trying to start trading options. You know why? It's because you're addicted to gambling. You're addicted to fast money, which then makes you gamble on everything. Investing is not a gambler's playground. It is a person who does not want to work until they dies, place to put their money to work for them over the long term. That's what it's for. It is an investor's gym. It is not a gambler's playground. This is not a gambler's speedway, raceway, NASCAR. And that's what he's talking about. So if you have that mentality, you need to go to a Gamblers Anonymous first and get that mentality out of you, or you're gonna, and that's how you check yourself. You check yourself into one of those before you wreck yourself out here, because that is not how you want to do it. Let me let him finish this and we're gonna end this video here. And I'll remember pick up from about 15 minutes next week.
So I wanted to really tell people and stress to people that it's important to take your time. Take your time to learn the information. Take your time. It's not a rush. Like I said, I started when I was 17. I didn't start trading until I was 19. So I really want to stress that point home. And also the short-term options.
What I admire most about Grammarly is that you're still in control of the writing. It'll generate a handful of topics.
For someone that does not know technical analysis, that is brand new, is like going to the Russian roulette table in Vegas. And I'm going to say that one more time.
Okay, not Russian roulette. That's with firearms. He just means roulette.
Someone trading short-term options without knowing technicals is like going to the Russian roulette table in Vegas. And I'll leave that one there.
Roulette.
Don't do it. Strictly for live.
All right.
But not for freshmen. That's not for freshmen. All right, let's keep rolling.
All right, before he keeps rolling. So we're at 14 minutes and 35 seconds. I will have this next week for you. We'll finish out the other like 21 minutes thereabout. Look, I hope you got something from this. If you missed any of the show, please go back on YouTube and watch it. I usually have this edited and uploaded within 30 minutes. And I'm just giving myself a buffer here because I have a wife and kids. But usually this thing is up in like 10 minutes. Because all I do is I go to Clipchamp, put the video clip in there, I upload it to YouTube. And the longest thing that it takes to do is process, right? I then go on Clipchamp and I put a photo on there. I put what's going to be the thumbnail. I put one of my photos. I take the background out. I put the words on, mark it, what it's going to be about, maybe throw a picture on there, and I get the thumbnail ready. I use the AI that I pay for. I forget what it's called, vidIQ, and I get a good title that's going to pop on YouTube. And then I go ahead and I as soon as it's finished processing, I hit upload. I make it go public right away. So if you missed any of the show and you caught some of the Discord, don't even worry about it. Just go ahead and catch the part that you missed. But part 2 is coming next week. Do not miss this. Tell somebody during the week. If you're in Discord, shout it out, what you did learn or whatever. And make sure people are here because I'm trying to help everybody, right? I was never taught this stuff. I had to learn this stuff. It's near and dear to my heart, and people have been asking for options classes, and here it is. We're going to teach more of these, and I'll show you how to do one here live. I'll probably do it next week. After things have come down a bit, I'll probably do an options call, actually submit one next week live. So if you, anyway, the Forge is going cold this week. Thank you. I pray that you have a good weekend and a great week. And I will see you next week here live. The Blacksmith is out.